Welcome to Crypto Answers, the channel where we take focused questions on digital assets and explain them in short, concise videos, one at a time. Okay, we have a question today submitted by Piazza Research regarding stablecoins and what's the use case? And specifically, why would I want to own UST? I'll just hold dollars or Bitcoin directly. Stablecoins do not have value to me. Plus, one can make the argument that Bitcoin is the stablecoin. And continuing, also, Terraform Labs and the Luna token are centralized projects running proof of stake with CEO Do Kwon making all decisions and profiting from the probable pre-mine. If the project fails, the BTC billions they bought will probably have to be poured onto the market. Not a fan of this type of project. Okay, just to catch everyone up here, this question I'm sure is in response to a video I did on news for April 10th, 2022. And one of the things I had covered was that Terra and Luna were putting Bitcoin on their balance sheet. So basically going out and buying Bitcoin to secure the UST, which is the stable coin offered by the Terra ecosystem. And Do Kwon is the CEO of Terraform Labs, which is the company that develops the Terra and Luna ecosystem. All right, this is a good question. But before we dive in, let's set the stage and give a little background on what exactly stable coins are, so everyone understands. So, stable coins are utility tokens that are supported by a particular blockchain, and they're pegged to the U.S. dollar. So that's the idea, is that you're trying to establish an anchor between the value of these utility coins and the US dollar. And they're usually collateralized, which means they're backed by something. And it's usually US dollars or some sort of commercial paper. Um, and it was interesting in the news item is that what Terra is doing with UST is they're starting to back their stable coin with Bitcoin, which really, in my mind, it's sort of legitimizing the whole crypto space by doing that. And that's why I thought it was an interesting story to go over. It's important to understand that stablecoins are not FDIC insured. Like the money in your bank account, it's insured up to, I don't know, $200,000 or something like that. That doesn't exist with stablecoins. Many exchanges, including decentralized exchanges, don't support US dollars, though. And big transactions incur large fees to move money around and take time to clear. So, and this is one of the reasons why people start looking at stable coins, is because banks have fees for, on just about everything, and they're slow. And banking hours. If you want to do something over the weekend, you can't. And even if you're doing a transaction during the week, a lot of times it takes days to clear. And so I think stable coins have a place here. And big transaction counterparties do not want the value of the asset moving around drastically that they're trading with. So Bitcoin, over the period of days or even hours, can move around substantially, and that can have an effect on the transaction. Stablecoins cut banks out of the picture. That's why I think banks don't like them, um, because banks, they're operating in uh, kind of like in the Stone Ages. They're very slow. They've got all kinds of fees, and this is something that threatens their bread and butter. All right, let's dig a little bit further into the usage. I've got it split into two categories of users. You got regular folks and you've got institutions. So regular folks um, might use stablecoins as a parking place between trades. So you're trading out of some asset, some crypto, and you want to park the funds somewhere temporarily. Well, that's a good place to use a stablecoin. And another usage would be yield generation. So there are places where you can get USDC anywhere from 7 to 9% is typical, or you can go to Anchor Protocol with UST, and they're paying almost 20%. Now, be careful with these. I mean, all of this is not something that's FDIC insured like you're used to using in a bank account. And in the case of Anchor, I don't really think that 20% APY is going to be sustainable. They're actually scheduled to reduce that rate to, I think, 18% over the next month, and I would expect over time it to drift down lower. And the other thing that just kind of happened over the last couple of days is that a lot of the centralized providers for yield are really getting cracked down on, and they're not allowing people who are not accredited to be paid yield. So I think that decentralized finance is going to be really the only route to get yield on stablecoins, probably within a short period of time now. Another usage would be liquidity pairs. So if you're familiar with doing any trades on let's say a stock, and you notice how it happens almost immediately. Well, the reason why it happens that way is because people had posted up their stock in order to have that trade go through. So they basically borrow the stock for a very short period of time and then pay it back, and then they pay someone for that privilege. So a liquidity pair is when you have two assets that you're posting collateral on, and so that you're providing the ability for people to trade between those two assets. And because stable coins are so commonly used in liquidity pairs, that's another where you could potentially get some yield. And like I said, likely coming is going to be purchases of large items. So if you're using something like Bitcoin and you're trying to make a purchase, the problem is if it moves around, the it may work into your favor or against you either way, and it might move in a direction you don't really want. So it's a lot of people prefer to have a stable coin in between where they can park the funds and then transfer the goods or services that are being purchased. And then switching gears over to the institutional side, hedge funds and large institutions will will use stable coins for speculation. So they'll use it to increase their leverage and to make arbitrage trades. So arbitrage trades is when they're finding small deviance in the market, and they'll find something on one exchange trading at a different price than another, and they'll buy it and sell it real quick. And stable coins are a good use for moving those funds around really quickly. Another thing that they do is they've got this spot to future disparity that they've been using. So they see a difference in the current price, which is what they call spot, and the future, which is something maybe a couple of months out. And what they do is they'll borrow your USDC. They're able to pay whatever 9% on it, and they'll make 20% on that trade. So they're happy to do that. And uh, institutions are also big providers of liquidity pairs. That's it for today's video. Thanks for listening, and thanks for the question. I hope my answer was somewhat of value. I really enjoy digging into this stuff because I'm a firm believer that the best way to better understand something is to try and explain it to someone else, and that's what this forces me to do. So if you guys have more questions, please send them along. Either put them in the comments or in the URL that's there I have listed. If you're enjoying the videos, please consider subscribing. And if you guys have any other comments, please put them in the comments. Drop me something in there and let me know if you have suggestions or something like you'd like to see or something you don't like seeing. Just let me know. Thanks.